In the world of investing, there are many different paths a person can find themselves taking. Whether you are a growth investor or a day trader or a value investor, you tend to adhere to a certain set of principles that define your investing philosophy. The world of value investing specifically can be rather captivating. It's a concept that was introduced by Benjamin Graham in the 1930s in his book Security Analysis, and then further popularized later on by Warren Buffett pretty much throughout the past 50 years. And value investing preaches things like margin of safety, buying below intrinsic value, and investing in what you actually understand, and viewing investments as ownership stakes in real businesses rather than just pieces of paper or things that you can trade on a day-to-day basis for a quick buck. So some of the most prominent value investors today include guys like Monish Pabrai, Seth Klarman, Joel Greenblatt, and all of them have earned market-beating returns for their investors for several decades now. So when you have all of these prominent value investors owning the same company, I think it's worth giving that company a deeper look. And that company is Micron Technology. In fact, it's not just a few value investors that own it. Out of a notable 10 investment funds that I looked up that are run by people that describe themselves as value investors, 6 of them had at least 1% of their portfolio in Micron. So what do these investors see in this company, and why do they think the market is failing to recognize the potential of this company that is probably causing it to be undervalued? So after doing some pretty simple research, I think I came up with 3 key points that I think investors tend to see in Micron when they look at it. And these points are: number 1, the economic moat or perceived economic moat; 2, the strong growth runway that the company has; and 3, the relatively cheap valuation that it currently has. So that's what we'll go over today. But before we get into that, if you are new to my channel, I greatly appreciate it if you'd consider subscribing. My goal is to get this channel to 5,000 subscribers by the end of the year. So if you could help me reach that goal, I would greatly appreciate it. But anyways, let's dive in and first start with the economic moat. So this really refers to the key advantages that Micron has over other companies in their industry or over companies potentially looking to enter that industry. Things that cannot be copied by other companies and should lead to a sustained competitive advantage for Micron for a long period of time. Now, really the best way to spot a company with a moat is to do so in hindsight. For example, we all know that Google has an economic moat in search because they own pretty much majority of the search engine market, about 90-95% of it, and pretty much everyone uses them. However, spotting an economic moat before it becomes obvious is very difficult and probably involves a lot of luck more than anything else. So let's first give a quick overview of the semiconductor industry as a whole and also Micron's business, because then we can drill down a bit further and decipher if an economic moat actually exists. So Micron operates in the semiconductor industry, which is one of the most absolutely critical industries to the modern economy. And normally this industry is described by the following 3 things. Number 1, it's highly specialized. Number 2, it's globally dispersed. And 3, it's interconnected. So Micron specifically is on the memory and storage side of the chip industry, and they specialize in making 2 types of chips, which is the DRAM or dynamic random access memory, which consists of about 75% of their revenue, and NAND, which is non-volatile flash type of memory. And this consists of a quarter of their revenue. So while they do operate in the semiconductor industry, they just operate on the memory and storage side of it. So they are very, very specialized. Like I said, that's just kind of the nature of the semiconductor industry. But as we'll establish throughout this video, it's this very specialization that makes them intriguing from an investment standpoint. And these devices get put in all sorts of modern technologies like PCs, smartphones, servers, 5G networks, all types of devices that are very, very important, and even devices that enable certain developing technologies like augmented and virtual reality, facial recognition, voice recognition, real-time translation, scene detection, and many more of these new age type of technologies. So all of these devices that we use on a day-to-day basis require Micron memory and storage devices in them. Okay, so now we know a little bit about Micron. Let's drill down to see what actually makes them unique from other companies in this industry, because they aren't the only one. And one of the big reasons has to do with barriers to entry, number 1. Now, for those that didn't take a first-year business course, this basically just refers to how difficult it is for either a potential competitor to enter the industry or a new company, which would be a new entrant. So we know Micron is very specialized in what they do. In fact, they're one of only 3 DRAM chip producers in the world, are a major DRAM chip producer in the world. And remember, DRAM is about 75% of their revenue as of making this video. And the other two are Samsung and Hynix, both of which are based in Korea. So Micron is actually the only North American producer of DRAM chips, which are critical pieces that go into many important technologies, as we've already established. Now, that's how the market is currently, but these things could change, right? Other companies could see the opportunity and make an entry into this market, right? Well, not really. This is where the barriers to entry come in. Micron's manufacturing facilities are extremely difficult to replicate, not just terms of the sheer cost of them, but also how long it would take a potential new entrant in that industry to ramp up production, hire new staff, and eventually begin selling their products. Not to mention all the research and development that has to go into developing a proprietary product, which Micron and all the other companies in this industry have spent years doing. The manufacturing facilities alone cost tens of billions of dollars to build out, and probably around 3 to 5 years of lead time before the company could actually begin selling it. And really, there's only a handful of companies out there that exist that could even debate making that kind of investment in something like this. Micron also currently owns over 22,000 patents and recently announced they're committing $150 billion over the next decade to invest in new production and research and development. Partly this is in response to the chip shortage, but also in part because, well, they have to. Despite the fact that there is only three major players in the DRAM market, and the fact that DRAM is generally considered to be a commoditized market, it is still highly competitive, and industry peers are in a constant battle to do things like increase wafer capacity, which increases the performance of the chip, increase manufacturing yields, reduce die size of the designs. No company in the industry can afford to take their foot off the gas, because if they do, that could mean they fall behind and they may never catch up. So I would say that Micron does have an economic moat in that they're already a part of this industry and they have the tech and the manufacturing to stay competitive. However, it's not a very strong moat. If we were to compare this moat to something like Visa's payments network, that's something that requires very little investment for Visa to maintain. Whereas in the case of Micron, their technology requires a lot of investment. In fact, $150 billion worth of investment. So that's a lot. They can still be cash flow positive despite that investment, but they do have to make that investment to stay competitive. So let's move to the next point, which is the strong growth runway. Now, for those who aren't familiar with this concept, it essentially refers to the ability a company has to continue to grow its business for an extended period of time, so decades upon decades. So we already kind of touched on this previously, but let me list some of the high growth industries that Micron is currently supplying. So one is cloud computing. Now, this is one in Micron's latest earnings call that the CEO specifically highlighted. And we all know how fast businesses like Amazon Web Services, Microsoft Azure, and Google Cloud have been growing in the recent years. And Micron's DRAM chips are needed for the servers that these companies buy when they're expanding their data centers to offer cloud computing solutions to other companies out there that are developing software on top of it. And cloud computing in general is forecast to grow in the double digits for the next 5 years, about 16% compounded. So it is still a rather young industry. And Micron is, you can essentially think of them like a tax on this type of technology because their DRAM chips are absolutely essential. So another one is 5G. The DRAM chip is needed in 5G enabled devices, and they actually require about 50% more DRAM for faster processing than 4G enabled devices. So again, absolutely critical. And another one is autonomous driving, and more broadly speaking, artificial intelligence, because autonomous driving is really just a branch of artificial intelligence. So the CEO in a recent earnings call described autonomous driving cars as really data centers on wheels. He said that they are using more than 100 gigabytes of DRAM and approaching a terabyte of NAND in them. And features such as autopilot safety require more memory. It requires real-time decision making. So the trend that is just the autonomous vehicle will drive a trend towards more than 30 times DRAM content and greater than 100 times NAND content. So as AI gets bigger and as it gets pervasive and it advances, the demand for memory and storage is much bigger. Now, here are a few other key industries that they serve that I didn't go into depth on, but I just wanted to put them on screen here so you can kind of get the idea of the importance that Micron currently serves in all these high growth industries that are getting tons of investment into them that Micron is absolutely essential to. So these are just a few that I decided to talk about. So in summary, Micron is one of three major producers of a product that will become increasingly more important in the modern world. And keep in mind all the barriers to entry we discussed previously. Normally, how industries like this would work, industries that are experiencing an increase in demand, is if one company is earning excess profits, other company would enter that industry and drive down returns in the long run because they make the industry more competitive. So this is the economic theory aspect of it, but like the majority of economic theories, they don't actually apply to the real world. And this is due to just how difficult it is for another company to enter the DRAM market. It's also important to note that because DRAM is such a widely used chip, it is essentially a commodity, and its prices will fluctuate up and down depending on supply. So, what the other two companies in this industry are doing, if they ramp up production, and also demand, which we just touched on. So you want to think of this business as cyclical, kind of like other cyclical commoditized industries like oil companies or even fertilizer companies. And all this ties into my final point, which is the relatively cheap valuation. So the core principle of value investing is to buy a company when it's below its perceived intrinsic value, whatever you calculate that as to be. Any company, no matter how amazing the company may be, can still be a bad investment if you don't buy it at a good valuation, which sounds easy enough, but of course, the trick to that is actually calculating a somewhat accurate intrinsic value. Now, value investors recognize that they cannot predict the future, so they suggest buying companies at a low valuation as a way of reducing the risk of your investment. Micron currently trades at a PE of just 8.39 and a price to sales of about 2.5. But we on this channel, we're more interested in cash flows rather than earnings because cash flows are a much better representation of how you earn your investment back as an equity investor. So we can look at the enterprise value to unlevered free cash flow metric. And this is of interest to us because it represents cash flow and it's currently at about 19. So the PE ratio is much lower than the price to free cash flow ratio, which tells us the company must be investing heavily into capital expenditures because those would lower their free cash flow, but not have any effect on earnings yet until later on when the depreciation on those assets starts to get charged. Now, if we take a look at Micron's historical financials, starting with the income statement, there's a few things that stand out, and one of which is the fluctuating revenue and operating margins so this translates into rather unpredictable income. And this shows the company is rather cyclical, as we've already established. But it's cyclical, but it's trending upwards over time. So even though there's the ups and downs, it's still overall an upward trend, as we can see in the income and the revenue here. And we can also see that margins have expanded and revenue overall has grown in the past 7 years, as I have on screen here. Now, investors tend to not like unpredictability and prefer companies with more stable cash flows that are easier to forecast because cyclical industries require you to stomach some drastic price declines. Although it's still possible if you hold through those price declines that you could beat the market over longer periods of time, as long as the good years outweigh the bad years, it still is very difficult for an investor to stomach that. It's also likely that the reason Micron's PE is so low is because they just had a very good year. So investors are probably pricing in a future decline when the cycle reverses. And this is really the trick when investing in cyclical industries, is knowing where you are in the cycle, because usually it only becomes absolutely apparent when it's too late and the cycle is now in a new phase. Now, how cheap Micron's valuation will really depend on your own assumptions for the future, like revenue growth, operating margins, share buybacks, debt levels, cash levels, etc. So whether or not Micron is cheap is up for debate between individual investors, and I'll let that for you to decide. But I do want to point out the cyclicality of the industry, and despite the cyclicality, it is generally going up over long periods of time, which as a value investor, you tend to focus on the long term, 5, 10, 15, 20 years out. Another key characteristic in this industry is high R&D costs. So on screen here, I've taken some of the more notable companies in the chip industry, and we can see that as a percentage of revenue, they're spending about 2 to 4 times as much on R&D versus on the cost that they just need to spend to keep the business running, like SG&A, which is selling general administrative expenses. So companies need to invest in R&D to make their products as technologically advanced as possible because, like we already said, that's really the only way they're going to remain competitive. And also, what stands out here is only 3.38% of Micron's revenues go to cover their selling general administrative expenses, which is much lower than any of the other companies on this list. So Micron doesn't really need to spend a lot of their revenue to keep their business running, which is an interesting insight. Something else that modern investors tend to prefer is asset light business models, which is the complete opposite of Micron. They are a manufacturing company, and in fiscal 2021, they spent over $10 billion in CapEx per year, and they have $36 billion worth of property, plant, and equipment on their balance sheet as of September 2021. Now, normally asset-heavy businesses have very high debt relative to their cash, which poses a risk because if the company begins to incur losses, which is likely to happen in a cyclical industry like semiconductors, that Micron does have $6 billion in long-term debt and over $10 billion in cash. So they are very financially strong. And if there is a downturn in the cycle, then they should be able to weather that storm. Now, if we take a look at the year-over-year price changes in DRAM and NAND, so I got this from the company's most recent 10K, we can see that they do tend to fluctuate pretty significantly. Pretty much they're going up or down by a double-digit percentage every year. But Micron is very financially strong. They have about $6 billion in long-term debt with over $10 billion in cash. So they do have the ability to weather any storms like that. So, in conclusion, Micron is a very well capitalized company that operates in an industry that is cyclical, but generally goes up over time, and is one company in a three-company oligopoly that sells DRAM chips that are needed in a multitude of modern technologies that are all growing rather rapidly. So what's not to like about this company? Well, there are some risks. As with any company, there are going to be risks. And for Micron, a big risk has to do with the Chinese government. Depending on what happens with the US-China trade war, Micron may lose a percentage of their sales either to the US, or if a Chinese government imposes restrictions on who they can sell to. This is a very real possibility and one that is very difficult to anticipate in advance, especially if you don't have any sort of inside knowledge on the matter. And another one is Micron is a very top-heavy business, with their top 10 customers making up about half of their revenue. And we saw this risk unfold in 2019, 2020 when they lost Huawei as a customer and they saw their sales decline. As we can see on screen here, their sales did actually decline pretty significantly. So there's the risk that it's a cyclical industry and also the fact that they could lose one of their major customers, which would mean their revenue takes a massive hit. Or depending on what happens with the US-China trade war, which personally I'm not going to speculate on, they could end up getting cut off from an entire market in a different geographical area. But anyways, guys, that pretty much does it for this video. So thank you so much for sticking around and listening to my thoughts. I really hope you did enjoy it. If you did, then please leave a like and subscribe if you are new, and I'll see you in the next video.